Picture this: Nvidia skyrocketing to a $3.4 trillion market cap, second only to Apple, thanks to its dominance in AI chip technology. But what if I told you two other tech giants, Amazon and Alphabet, might leave Nvidia in the dust by 2029? Yep, you heard that right. While Nvidia basks in the AI boom, the real long-term winners could be quietly building their empires. Intrigued? Let's break it all down. Hi. In today's video, we're going to explore why Nvidia's meteoric rise might not last and why Amazon and Alphabet, Google, could be the stocks to watch over the next 5 years. Thank you for watching, and please subscribe to my channel, The Finance Savvy, for more updates and insights. Got questions? Drop them in the comments or feel free to reach out. Let's dive into the video. The rise and risks of Nvidia. Nvidia is having its moment, no doubt about it. With a $3.4 trillion market cap as of December 2024, it's riding high on the AI wave. Its GPUs power everything from AI training models like ChatGPT to advanced cloud systems. Frankly, it's the king of the AI chip hill. But here's the twist: markets don't just reward short-term dominance. Nvidia's current valuation feels stretched. It's trading at over 30x sales and 110x earnings, wildly high, even by tech standards. Sure, the generative AI boom could push it higher in the short term, but sustaining this growth? That's a whole different ballgame. Let's be real. Nvidia's stock price reflects years of future growth baked in. It's like buying a car and paying up front for gas you'll use in 2030. The market's expectations for Nvidia are sky high, but when the hype cools, and it will, things could look very different. The competition is heating up. Here's the thing: Nvidia isn't playing alone. Advanced Micro Devices, AMD, and Broadcom are already nipping at its heels with competitive AI accelerators. And it doesn't stop there. Big tech players like Amazon and Alphabet are creating their own AI chips to meet unique internal demands. Think about it. Why rely on Nvidia when you can custom build your own solution? Alphabet's TPUs, tensor processing units, and Amazon's Inferentia chips are gaining traction, and they're designed specifically for the tasks these companies prioritize. The cherry on top? Nvidia, like most chip companies, doesn't manufacture its own products. It relies on third-party fabs like TSMC, meaning it's vulnerable to supply chain disruptions. Remember the 2020 to 2023 chip shortage? If history repeats itself, Nvidia might struggle to meet demand. And let's not forget pricing pressure. Nvidia's 76% gross margins suggest monopoly-level pricing power, but as competition heats up, those margins could shrink. A world with multiple viable AI chipmakers won't let Nvidia keep charging a premium forever. Amazon and Alphabet, the silent titans. Now, let's talk about the real stars of the show: Amazon and Alphabet, Google. These aren't just companies, they're ecosystems. Unlike Nvidia, which relies on cyclical demand for chips, Amazon and Alphabet thrive on diversified revenue streams. Amazon, from retail to AI leader. Amazon's journey from online bookstore to global e-commerce and cloud giant is legendary. But here's what makes Amazon special: its ability to reinvent itself. Take Amazon Web Services, AWS. It basically invented modern cloud computing. AWS doesn't just dominate the cloud market, it's Amazon's cash cow, funding everything from drone delivery to AI innovations. And speaking of AI, Amazon isn't playing catch-up. With its Bedrock AI service and custom-built Inferentia chips, Amazon is carving a niche in generative AI. Imagine AI tools integrated seamlessly into Amazon's ecosystem, from Alexa-powered smart homes to predictive shipping algorithms. Here's the kicker: analysts expect Amazon's earnings to grow at an 18% compound annual growth rate, CAGR, over the next 5 years. That's not just steady. It's impressive for a company already worth over $1.6 trillion. By 2029, Amazon could easily surpass $5 trillion in market value. Alphabet, more than just Google search. Then there's Alphabet. Sure, it's best known for Google search, but Alphabet is a tech powerhouse with diverse interests: YouTube, Android, Waymo, self-driving cars, and yes, AI. Alphabet's DeepMind is at the forefront of AI research, and its tensor processing units, TPUs, are redefining what's possible in machine learning. In fact, Google's AI models power everything from search engine updates to YouTube recommendations. And don't sleep on YouTube. It's still the go-to platform for video content, generating billions in ad revenue. Plus, with the rise of short-form video, YouTube Shorts is taking on TikTok in a big way. Financially, Alphabet's outlook is just as strong as Amazon's, with analysts projecting a 16% CAGR for earnings through 2029. With its relentless innovation and diversified portfolio, Alphabet could also hit a market cap north of $5 trillion in the next 5 years. Why Nvidia could lag behind. So, where does this leave Nvidia? Don't get me wrong, it's an amazing company. But its reliance on the AI chip market makes it vulnerable to competition, supply chain issues, and pricing pressures. And remember, the stock market isn't just about hype, it's about value. As legendary investor Benjamin Graham once said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Right now, Nvidia is in its popularity contest phase. But when the market shifts to weighing fundamentals, Nvidia's valuation might not hold up. Meanwhile, Amazon and Alphabet have proven they can adapt, innovate, and thrive in almost any environment. They're not riding a single trend, they're building the future. Here's a detailed analysis of Amazon, AMZN, and Alphabet GOGL, including their current performance, growth prospects, and challenges. Amazon Nasdaq, AMZN. 1. Business overview. Amazon operates across 3 major pillars. E-commerce, a global leader in online retail, supported by its unmatched logistics network. Amazon Web Services, AWS, the largest cloud computing platform, which generates a significant portion of Amazon's profits. Other ventures, Amazon Prime subscriptions, advertising, AI technologies, and experimental projects like drone delivery. 2. Strengths. A. Dominance in e-commerce and logistics. Amazon's global e-commerce platform dominates the industry with its one-day or same-day delivery options. Its logistics capabilities, including warehouses, delivery networks, and robotics, give it a unique competitive edge. B. AWS as a cash cow. AWS controls around 32% of the global cloud market as of 2024, making it the undisputed leader in cloud services. Cloud computing continues to grow, with AWS expanding into AI, quantum computing, and serverless technologies. C. Advertising growth. Amazon's advertising business has become a hidden gem, generating over $38 billion annually. It's now a serious contender against Google and Meta in the digital ad space. D. AI integration. Tools like Bedrock AI and Inferentia chips position Amazon as a player in generative AI. Alexa, Amazon's voice assistant, integrates AI across smart homes and retail shopping. 3. Challenges. A. Narrow margins in e-commerce. While e-commerce generates massive revenue, its profit margins remain thin due to high costs for logistics and delivery. B. Regulatory risks. Amazon faces antitrust scrutiny in the US and Europe, particularly over its market dominance and treatment of third-party sellers. C. Competition in cloud. While AWS leads the cloud market, competitors like Microsoft Azure and Google Cloud are gaining ground, particularly in AI-based services. 4. Growth prospects. Revenue growth. Analysts project a 14% to 18% annual growth rate through 2029. AI and automation. Amazon is heavily investing in AI for logistics, cloud, and even its core retail operations. Prime membership expansion. The continued rollout of new Prime benefits is expected to lock in more subscribers globally. Amazon remains a solid long-term growth stock, fueled by its diverse revenue streams and relentless innovation. Alphabet, Nasdaq, GOGL. 1. Business overview. Alphabet is a holding company with Google as its core business. Key revenue drivers include search and advertising. Dominates the global digital ad market via Google Search, YouTube, and other properties. YouTube. the largest video sharing platform, generating billions in ad revenue. Cloud computing. Google Cloud is Alphabet's fastest-growing segment. Other bets includes Waymo, autonomous vehicles, Verily, health tech, and AI-driven projects like DeepMind. 2. Strengths. A. Advertising dominance. Google search accounts for over 90% of global search engine market share, generating enormous ad revenues. YouTube remains a leader in video ads, with the rise of YouTube Shorts helping Alphabet capture younger audiences. B. AI leadership. Alphabet's DeepMind is at the cutting edge of AI, creating breakthroughs in machine learning, healthcare, and gaming. Products like Bard, AI chatbot, and tensor processing units, TPUs, position Alphabet as a leader in generative AI technologies. C. Android ecosystem. Android powers over 70% of the world's smartphones, creating a massive ecosystem for app developers and advertisers. D. Cloud computing growth. Google Cloud's market share has risen to 11% in 2024, driven by enterprise demand for AI and machine learning solutions. It's increasingly competitive with AWS and Microsoft Azure. 3. Challenges. A. Dependence on advertising. Over 80% of Alphabet's revenue comes from advertising. Economic downturns or stricter privacy regulations, e.g., Apple's app tracking changes, can disrupt this stream. B. Regulatory and antitrust pressure. Alphabet faces antitrust lawsuits in multiple jurisdictions, targeting Google Search and Android's default settings. Potential breakup or restrictions on its ad business could impact profitability. C. Fierce competition. In AI, Alphabet faces competition from OpenAI, Microsoft, and Meta. In cloud computing, its market share still lags behind AWS and Azure. 4. Growth prospects. AI as a catalyst. DeepMind and Google AI will drive innovation across healthcare, search, and enterprise solutions. Cloud expansion. Analysts project Google Cloud's revenue to grow at a 20% CAGR over the next 5 years. YouTube monetization. Enhanced features like shopping integration and YouTube Shorts ads will contribute to sustained growth. Alphabet's diversified portfolio and investments in future technologies make it a promising long-term play. Head-to-head comparison. Amazon market cap, 2024, $1.6 trillion. Alphabet market cap, 2024, $1.8 trillion. Amazon revenue growth, 2023, 11%. Alphabet revenue growth 9%. Amazon cloud market share 32%. Alphabet cloud market share 11%. AI leadership Amazon, strong in applied AI. Alphabet, strong in foundational AI. Regulatory risk Amazon high. Regulatory risk Alphabet high. Growth potential Amazon high. E-commerce plus AI. Alphabet high. Ads plus AI plus cloud. Key takeaways. Amazon. Amazon's strength lies in its diversification across e-commerce, cloud computing, and advertising. Its growth in AI integration makes it a top choice for long-term investors. Challenges like thin margins and regulatory hurdles are worth monitoring, but AWS provides a stable profit engine to fund its ambitious innovations. Alphabet. Alphabet is a cash-generating machine, leveraging its dominance in search, YouTube, and Android. Its commitment to AI and cloud computing positions it as a key player in future tech markets. However, over-reliance on advertising and regulatory risks are potential headwinds. Both companies are excellent long-term investments with distinct strengths. Alphabet is ideal for investors seeking a leader in AI and advertising, while Amazon offers robust growth across diverse industries, including e-commerce and cloud. Let me know if you'd like to explore specific areas in more detail. Again, thanks for watching. If you found this video helpful, don't forget to like, share, and subscribe to the Finance Savvy for more insights. Got questions? Feel free to reach out.